Let's talk more about the markets and what's working. Carmel Wellso, Director of Equity Research at Janus Capital, and Francois Trahan, a strategist at UBS, with a call out this week targeting 2550 for the S&P 500 year end. Welcome to you both. Francois, I have to start off with you. That's 300 points lower from where we are right now. So what is the path there?
Well, trade is obviously dominating the media and the day-to-day volatility. What I'm trying to do is remind people that there's this other story behind the scenes, and it's that we still have to digest what the Fed did, the lagged effects of these rate hikes. They take a long time to weigh on the economy. And so even if trade goes away, we still have a bit of a slowdown to contend with. And that's, I think, the bigger story.
So some people will say, I thought that we've been seeing, in terms of the snapback from December 24th lows, that was the impact of the markets digesting the Fed's pivot. And so why are we thinking about the rate hikes that took place prior to that at this point in the market's lifespan?
Sure, because it takes, I think the biggest misconception in this industry is how long it takes for interest rates to show up in the economy. And stocks are leading indicators of the economy at the end of the day. So historically, it takes almost a year and a half. So you got to wait a year and a half past the peak in rates for the data to fully reflect. And so that last rate hike, late in the year, we're talking about, it's not going to show up in leading indicators of the economy until basically the spring of next year.
So if I listen to UBS, and if I sell everything right now because I don't want to be in to go to 2550, and it goes to 3300, and I say UBS told me to sell, is that a fair statement? Do you speak for UBS?
Well, I'm the equity strategist at UBS, sure.
The one?
The U.S. equity strategist.
No one else has a higher...
well, I'm sure you'll find plenty of people with opinions. Listen, at the end of the day...
UBS, do you speak for UBS on this?
I do, yeah.
Okay, so UBS is saying get out of the market.
No, I don't think that's the message at all. Listen, at the end of the day...
What is the market?
Why would that not be the message?
300 points to the downside.
Listen, if we hit the 2550, the S&P will be up 2% for the year. Right, we were down 6 last year, so put that in perspective. I don't think I'm describing a scenario. It's the end of the year. That's the end of the world where everybody has to get out of stocks. I just don't think it's what consensus.
Why wouldn't I get out and buy it back at 2550 if you really?
Well, if you're a short-term investor and you really see it
short
that way.
term, that's avoiding a 12% loss or whatever it is, or is that how much it? What is it?
Yeah, for most institutional investors, it's going to be more about positioning their portfolios appropriately for a slowing economy.
I thought we had other UBS analysts that were actually more constructive on the market.
I'm sure you'll find different opinions.
But
Listen,
that's the house view. Everywhere. The house view is 2550.
Correct.
Okay. Carmel, where do you see the markets?
I think they're up from here. Let's take it at the very basic level. In the United States, we have an election coming. We've already started all the talk that kind of leads up to that. I think that Trump and even the Fed looks at the stock markets as a sign of how the economy is doing. And so they're going to do what they need to do to get that up. And I think that the trade tensions right now are temporary. We'll get some resolution. I don't know if it's next week or if it's in a month, but it's in China's best interest as well to get this taken care of. And, they've got their 70th anniversary coming up. And so both leaders need to look strong heading into those political events. And they're going to do what they need to do to get it done.
And what is the backdrop against which they will be trying to do that? Of course, we can't say that they can magically make it all happen, but in terms of just the trend in growth and how assets are priced relative to the growth.
Right. If we take a step back, look at what's happening in the markets. When we're talking to companies, so we do fundamental analysis, it is on the balance, much stronger. Things are stabilizing in Asia. They're accelerating in Europe. You've actually seen that in the macro numbers. We're still digesting a pretty big stimulus from China in that market. So what's the one thing that can derail it? It's the trade talks. Now, both of these two leaders can actually declare a victory. If they go back and, we can have on our side Trump saying, look at all these huge tariffs that were slapped on us. We took them down to zero. Even though it's net no change, it'll still be a victory and look positive going into the elections. And valuations, I hear a lot of people saying they're too high right now, but low interest rates, I think the next move down is we're flat to down from here. The next interest rate rise, at low interest rates, valuations should be higher. And it isn't as cyclical in any of the indices as it used to be. There's been a big shift towards non-cyclical secular winners.
Does the 10-year yield tell us anything at this point, Francois? A lot of people are making a lot of the fact that the 10-year yield is at the lowest of the year. And we've also seen some inversion in parts of the yield curve overnight. And so I'm wondering if that's an alarm bell. I mean, I guess maybe everything is with 2550 on the S&P.
Well, again, it's hardly the end of the world. Interest rates are doing what they normally do at the end of a Fed tightening cycle. They're starting to price in the other side of the story. And so I would say that's very consistent. Here, I'll give you a very simple stat. If you look at the last 8 Fed tightening cycles, 8 out of 8 times what followed was a slowdown. So irrespective of what you think, what your view is here, even if you think the market's going to 3,300, I think you have to take that into consideration and admit that a Fed-induced slowdown is a risk to equities here.
I'm sure people throw the kind of one exception in the sense of how the Fed has navigated this, which would be the mid-90s. Very heavy tightening cycle, did get a pretty steep slowdown in 1995, and then a quick easing, no recession, and then the late 90s with a magic.
That is the one of the last 12 tightening cycles, that is the one exception. Of course, that's the one everybody's gravitating toward. Who doesn't want that scenario?
And so you think simply because of the odds of it not happening again?
Well, I don't see anything that's behaving that way. I see things that are behaving like the other 11 episodes, if anything.